only 3 of the Magnificent 7 are actually worth watching right now. And here's what's wild. One of them is trading cheaper than the S&P 500 on a forward basis. Most people still treat the Mag 7 like a package deal. You buy the group, you beat the market. That worked for a while. It's not working anymore. In this video, I'm going to break down which 3 Mag 7 stocks I think are worth considering right now, exactly why AI gives them an edge the others don't have, and how they actually stack up against the S&P 500. And stick around, because my number 1 pick at the end is the one that most investors are getting completely wrong right now. I'm not a financial advisor. This is how I think about it. All the numbers I'm sharing are current as of filming this video, so they may shift by the time you're watching. But if you're building a portfolio right now, this is the framework I'd want someone to show me. Let's get into it. When I first pulled up the earnings estimates for 2026, I honestly had to double check the numbers. Mag 7 earnings growth is expected to be around the low 20s in 2026, while the other 493 S&P 500 companies are closer to roughly 12%. That gap used to be massive. In 2023 and 2024, the Mag 7 were growing earnings 2 to 3 times faster than the rest of the index. That's why everyone piled in. But low 20s versus 12? That's not the blowout it used to be. Meanwhile, you can buy the entire S&P 500 for roughly 21 times forward earnings. 500 companies, automatic diversification, about 12% earnings growth. No research required. So any Mag 7 stock has to clear that bar. It has to justify picking it over the index. And if you own any of these stocks right now, pay attention, because not all 7 clear it. Not even close. Let's start with number 3, NVIDIA. I know what you're thinking. NVIDIA's already had its run. Everyone knows about it. What's left? A lot, actually. Revenue grew 62% year over year last quarter. Management is projecting global data center capex to go from $600 billion in 2025 to $3 to $4 trillion by 2030. That's not a small TAM expansion. That's the entire infrastructure of AI being built in real time. And here's the part that surprises people. NVIDIA's forward PE sits around 23x. For a company growing revenue at 62%, that PEG ratio, price to earnings divided by growth, is actually more attractive than most of the Mag 7. Amazon is building custom chips called Trainium. Google has TPUs. If big cloud customers bring chip design in-house, NVIDIA's dominance gets tested. And any pullback in AI spending hits NVIDIA first and hardest. But right now, the demand is there, the growth is there, and the price isn't crazy. You're just paying a small premium over the S&P 500, except you're getting 5 times the growth rate. That combination doesn't happen with a company this dominant. Now, if NVIDIA surprised you with 23 times forward, the next one is going to surprise you even more, because the market is basically handing it to you. Number 2, Alphabet. Alphabet is trading at roughly 26 times forward earnings. That's a slight premium to the S&P 500, but for what you're getting, I think the market is underpricing this company a little bit. The bear case on Alphabet has been the same for 2 years. AI is going to kill Google Search, ChatGPT, Perplexity. All these AI tools are going to steal search traffic and the ad revenue that comes with it. Here's what actually happened. Paid click growth re-accelerated through 2025. Not slowed down, sped up. Turns out when 3 billion people are in the habit of typing questions into Google, that habit doesn't disappear overnight because a chatbot exists. The AI threat to search is real long-term, but the market priced it in like it's happening tomorrow. Google sits on one of the largest pools of user data on the planet. Search data, maps data, Gmail, YouTube watch history, Android usage. That data is a key input for training and improving AI models. Every company building AI wants access to data like this. Google already has it. That's not just the moat around search. That's a moat around the entire AI race. And then there's Waymo. Waymo passed 14 million autonomous rides in 2025 and is expanding to 20 cities in 2026. This is a real business that's scaling, and the market is giving it to you for basically nothing at this valuation. On top of all that, YouTube ad revenue is still climbing. Google Cloud is growing, and their AI tools are being deployed across every product line. Alphabet at 26 times forward with search, YouTube, cloud, a data moat that feeds directly into AI, and Waymo scaling, that's a lot of business for a small premium over the index. But here's the thing. My number one pick is even more mispriced than Alphabet, and it's the one most investors are avoiding for the wrong reason. Number one, Meta. Meta trades as a forward PE of roughly 20x. The S&P 500 sits at about 21. Meta, growing revenue faster than almost every mega cap on the planet, is trading below the index on a forward basis. This is a stock I teased at the top of the video. And yes, a Mag 7 company is actually cheaper than S&P 500 right now. How? Because investors are spooked by the CapEx. Meta raised its 2025 spending forecast to $72 billion, and they said 2026 would be notably larger. The market saw that number and panicked. But here's what the market is missing. That spending is going directly into AI infrastructure, and it's already paying off. Meta's ad platform runs on a system called Advantage Plus. It uses AI to optimize ad targeting, creative placement, basically every part of the ad pipeline, and it's working. Revenue is accelerating. On top of that, WhatsApp has over 2 billion users and is barely monetized. Threads is growing. Instagram Reels is competing with TikTok. These are all free options the market is essentially ignoring at this price. That's the kind of disconnect I look for. The market is focused on the CapEx number. I'm focused on what the CapEx is producing, and right now it's producing results. Meta at 20 times forward with this growth profile is, in my opinion, the most mispriced stock in the Mag 7. Quick honorable mention, Microsoft. Azure grew 39% year over year. Commercial obligations surged to $625 billion. And then there's Office, one of the deepest moats in all of tech. Outlook, Excel, Word, Teams, embedded in the daily workflow of virtually every enterprise on the planet. You don't rip out Office. You just don't. And now Copilot AI is layered directly into that ecosystem, deepening the lock-in. The reason it's not in my top 3 is price. Even after falling about 23% in 2026, the valuation is still at the higher end of the group. Quality company, but I want a better entry point. Now, you might be wondering about the other 3. Apple, Tesla, Amazon. Apple is trading at about 33 times forward earnings on roughly 9% expected revenue growth. That's paying a big premium over the index for a company growing slower than it. The buyback program is massive, but a buyback isn't a growth story. Tesla isn't a category by itself. Nearly 200 times earnings with sales expected to decline. That's not an investment in a car company. That's a bet that autonomous vehicles and robotics work at scale. Could happen, but that's not how I allocate capital. Amazon is complicated. AWS is strong, 24% growth, massive backlog. But at 31 times forward earnings, the e-commerce side exposed to tariffs and consumer slowdowns, the cloud story has to carry a lot of the weight. Here's the big picture. The Mag 7 as a group trade at a forward PE well above the S&P 500's 21x. But for context, the 7 largest stocks at the 1999 peak traded at 66x earnings. So this isn't a bubble. But it's also not a free ride anymore. The gap between the Mag 7 and the rest of the S&P 500 is compressing, which means buying all 7 and hoping for the best is a strategy with diminishing returns. The move now is to be selective. Find the ones where AI is actually driving revenue today, not just a line item in a press release. Find the ones trading at or below what you paid for the index, and find the ones with enough optionality that you're getting paid to wait. For me, that's NVIDIA, Alphabet, and Meta. 3 companies where the AI story is real, the growth is visible, and the price doesn't require a leap of faith. Drop a comment and tell me which Mag 7 stocks you're holding right now. If you're building a portfolio, the question isn't whether to own the Mag 7. It's which ones are actually worth your attention.